Hey, I'm Jusko from ProudMoney.com. In this video, we are going to look at how credit card interest is calculated and how it is applied, when you have to pay it, when you don't, all those good things. But first, I'm going to ask you to please subscribe to this YouTube channel right here if you have not already. And if you have already, I thank you for doing so. So if you are somewhat new to credit cards, it might be a little confusing to you how credit card interest works, how it gets calculated, when you have to pay it, when you don't have to pay it, all that kind of stuff. So that's what we're going to take a look at. And the first thing that we are going to take a look at is when you don't have to pay it at all. So almost every credit card, with a very few exceptions, has what is known as a grace period. And what that means is if you had no charges on your credit card and then you charged some stuff to your credit card and then you paid all that stuff off before the due date that the credit card company gave you, you would not have to pay any interest on those charges. So if you got a new credit card, you charged $1,000 worth of stuff on that credit card, they sent you a bill and you paid off that whole $1,000 worth by the due date that they told you it was due, you wouldn't pay any interest. That credit card company would not make any money off of you in interest. You would basically just be getting a free loan for that month, a convenient way to buy stuff on your credit card, get it all paid off, pay no interest, and maybe even get some rewards. Just as a quick example from a recent statement of my own, you can see the last billing cycle went from July 17th through August 16th. So every purchase I made with that credit card from July 17th through August 16th shows up on this particular billing statement. You can also see that I had no balance to start with. I made purchases of a little more than $150. They are giving me until September 13th to pay those off. That is my grace period. If I pay everything off by September 13th, that whole $150 plus, I'm not going to have to pay any interest on those purchases. So that's the ideal. You pay off the complete balance before the due date. You won't have to pay any interest as long as you take advantage of that grace period. Doesn't matter how high the interest rate even is on your credit card because you aren't paying any interest. Now, every so often, some people are going to revolve a balance, meaning they have a balance in one month, they don't pay it off completely, it moves over to the next month, and that's when you do pay interest. So how do they calculate how much interest you pay each month? Well, I am going to give you a couple different versions of how it works. One super simplified that actually is not 100% accurate, and then I'm going to give you a more convoluted version which is more accurate but is a little harder to understand. The simplified version will pretty much give you everything you need to know. You'll have a ballpark idea of how it gets calculated, and if you want to go further and really understand the nitty-gritty, well, then you can keep watching. So when you signed up for that new credit card, you agreed to a certain interest rate, or what they call APR, annual percentage rate, that would be applied to the balances that didn't get paid off in full. Now, an annual percentage rate means an interest rate over a full year. But what the credit card companies are actually doing is applying an interest rate for a shorter period of time to the balances that you carry. So I'm going to use a simplified version of numbers here because I also think that this will make things easier. Let's say that you had a $1,000 balance on your credit card and you had a 24% interest rate, or a 24% APR. And let's say during that month you didn't make any more purchases, you just had that $1,000 sat there as your balance that whole month. Now, with a 24% interest rate, let's say they were going to charge you the interest on a monthly basis and they were just going to simplify it. They would take that 24% interest rate and they would simply divide it by 12 months, and you would be charged a 2% interest rate per month. So if you had a $1,000 balance and you got 2% on that, you would be charged $20 on that $1,000 balance you had. And so then when the month was over, you would have a $1,020 balance, the initial balance plus the $20 in interest. So does that make sense? It is the very shorthand version. You could take whatever your interest rate, whatever that APR is on your card, divide it by 12, and that interest rate is what you could think of as being applied to your monthly balance. So if you had a 24% interest rate, 2% per month. If you had a 12% interest rate, by chance, 1% per month. If you had an 18% interest rate, 1.5% per month. So fairly easy to understand, however, not completely accurate as to how it is really done. In reality, what the credit card companies do is they charge you interest on a daily basis, not a monthly basis. So when I give you those sort of ballparks and say a 24% interest rate could be thought of as 2% per month, that is an easy way to get a interest rate number that is very close to correct. However, it's not 100% correct. In reality, they would take that 24% interest rate, they would divide it by 365 days in a year, right? So that would mean 24% interest over the course of a full year would actually be 0.06575% every single day. So that's what they're going to do instead. So if we looked at that $1,000 balance that I talked about earlier, and we took that interest rate, that daily interest rate, multiplied by that, what we would get is about 66 cents per day in interest that would be charged to you. So over the course of a month, it would come out to about $20.38. So when I just ballparked it, I said it was 20 bucks. When we get a little more granular and we look at it on an everyday basis, it actually would have been $20.38. So you can see the ballpark's pretty close, which is why it's easy enough to use that. But that is how they actually do it, is per day. Now, I still haven't told you the whole story because in reality, most credit card companies use a number called the average daily balance as the basis for what they are applying that interest rate to. So far, I've only used an even $1,000 as the balance that you would have every single day on your credit card over a full month. But in reality, that's not how it works, right? We have a balance, we buy more stuff. At some point, we pay off some or all of that balance. So the credit card companies need a way to apply that percentage, that interest rate per day. And what they use is the average daily balance. And essentially what that means is the average balance over the course of a billing cycle. So in this case, let's say you started with $1,000 on your credit card balance, and then you bought something for 80 bucks. Maybe you went out to a restaurant, and 7 or 10 days later, you bought something for $40, and then another 7 to 10 days later, you bought something else for $40. Well, now you've got $1,000 on one day, you've got $1,080, and then you're up to $1,120, and then you're up to $1,160. So depending on how those things play out over the course of the month, you're actually taking what the balance was on every specific day during that billing period, adding them all up, dividing by the number of days in the billing period, and then that is your average daily balance, and then that is what is going to be used with that interest rate to figure out what the interest rate or what the interest is that should have been charged every single day. So let me show you that in actual numbers in case it didn't make sense. Over the course of a 31-day period, let's say 7 of those days you had a $1,000 balance. 8 of those days, after charging another $80, you had a $1,080 balance. Another 9 days after charging another 40 bucks, you had a $1,120 balance. And then the last 7 days of the cycle, you had charged another $40 and you had $1,160 as a balance for those last 7 days. So over the course of those 31 days, you had an average balance that was around $1,091. So we take that $1,091.61 balance, the average daily balance, we multiply that by the daily interest rate that we've already talked about. That's going to give us around 72 cents per day. We take that number between 71 and 72 cents, we multiply that by 31 days in the billing cycle, and we come up with a number that is just around $22.25 as the amount of interest that would be charged for that billing cycle. And then of course over time, when you make payments, you reduce your balance. So the next time around, if you don't make any more charges, your average daily balance is going to go down and you're going to pay less interest. If you make even more charges than what you paid, well then obviously your average daily balance would go up and then you would be charged more interest the next month. All right, now there's one last aspect here that I want to bring up. It really doesn't change anything I've said, but it's something I've sort of left out. And that is the fact that when you move from one billing cycle to the next, if you have been revolving a balance, you are still being charged interest every single day. So earlier I showed you that statement of my own that ended on August 16th. That was the end of the billing cycle, and then they said I didn't have to pay the bill until September 13th, right? Well, if I had been revolving a balance all those days between August 16th and September 13th, or whenever I paid the bill, I would still be getting charged interest. And sometimes people get confused about this because they think that they're not getting charged interest sort of in between. And so maybe when they go online, they see that the balance that they actually have is higher than what was shown on their bill, even if they haven't made any new purchases. And the reason is because interest has continued to accrue even in that period between when a billing cycle ends and the due date from that billing cycle. And probably the time when this comes into play the most and causes the most confusion is if someone has been revolving a balance on their credit card and then they pay it off in full, and then they get a bill the following month that still has more charges. They felt like they paid off the card in full. Why is more interest being charged? And the reason why more interest is being charged is because that billing cycle ended, and that time in between when the billing cycle ended and you paid it off, there still was a balance and there was more interest being charged to you. So you had already been charged interest, but you hadn't been billed for that interest yet. So that following month you would get billed for the interest even though you had paid off the previous balance in full. So in order to get that grace period where you don't have to pay any interest, you have to start from zero. If you don't start from zero and you have a balance during that month, well then you're still going to get charged some interest. So as you can see, it gets pretty convoluted, but for most people, all you really need is that ballpark equation. Take that interest rate, divide it by 12. That'll be your monthly interest rate. Multiply that by whatever your balance is, and that's going to show you ballpark how much interest you're going to pay for that month. More specifically, you're going to get into taking the interest rate and dividing it by 365 days and applying that to the average daily balance if you really want to know those very specific numbers. But anyway, that is how it works. If you have any questions, put them in the comments section below and I'll do my best to answer them. Otherwise, I thank you for watching, and as always, please go to proudmoney.com where we do credit card reviews, we talk personal finance, we talk deals, and all sorts of other fun stuff too. Thank you for watching. Bye.